Today we're going to talk about how you can profit from the recent surge in interest rates. Before I get into the investments though, here's a little bit of context that you should know. This week, the interest rate on the 10-year US Treasury note topped 5% for the first time in 16 years, while the interest rate on the 30-year Treasury neared 5.1%, also for the first time in 16 years. We haven't seen long-term interest rates this high in a very long time, and that naturally has people wondering, how do you take advantage of these high interest rates? That's what this video is about. Now, when it comes to profiting from high interest rates, there are countless ways to do it, but all of them can be put into two broad categories. One way to profit is by generating interest from an investment. This is similar to when you put money in a bank account. The bank pays you interest periodically for having money in your account. The other way to profit is to invest in something that'll appreciate in value if and when interest rates come down from today's high levels. The classic example of this is a bond. Bonds are essentially loans that can be traded among investors, and their price moves in the opposite direction to that of interest rates. So if interest rates go down, bond prices go up, and vice versa. So those are the two approaches to profiting from high interest rates: income and price appreciation. But they're not mutually exclusive. You don't necessarily have to stick with one approach or the other. You can use both. In fact, many investments have the potential to both generate income and appreciate in value. That said, generally speaking, most people prioritize one goal over the other. So think about what your priority is as I go through this list. Alright, so up first is the iShares 20+ year Treasury Bond ETF, which has the ticker symbol TLT. This has been an extremely popular fund among investors who want to bet on an interest rate decline. TLT owns treasuries with maturities of 20 to 30 years, so we're talking about very long-term bonds. And since these bonds don't get paid back for 2 to 3 decades, TLT is extremely interest rate sensitive. If interest rates go up, the price of TLT goes down significantly, and if interest rates go down, the price of TLT goes up significantly. We've seen both of these scenarios play out over the past few years. From the start of 2019 through the middle of 2020, the price of TLT surged as interest rates hit rock bottom levels during the pandemic. Then from 2021 through today, the price of TLT plunged as interest rates spiked due to high inflation. Anyone who made the unfortunate decision to buy TLT at its peak in 2020 has lost nearly half of their money. But that was a very different time. The interest rate on the 30-year Treasury bond was as low as 1% in 2020. Today, it's over 5%. That makes TLT today a fundamentally different investment than it was at any point during the past decade when interest rates were lower. There's more room for interest rates to fall from 5% than there was when interest rates were 1, 2, or 3%. And that means there's more upside potential for TLT. Additionally, a lot of investors believe that today's high interest rates will lead to an economic slowdown or even a recession, and that in turn, that slowdown will lead to lower interest rates. It's a pretty compelling thesis, and that's why so many investors have bought into TLT this year. A whopping $20 billion has been invested in TLT since the start of the year. Investors in the fund are betting that interest rates are close to their peak, and therefore the price of long-term bonds, like the ones held by TLT, are close to their lows. But as compelling as the TLT investment thesis is, it isn't risk-free. Since the start of the year, TLT has fallen by 14%, and almost anyone who has bought it is losing money. Why? Well, because interest rates have gone much higher than most people expected. The bullish thesis for TLT that I outlined just a moment ago is the same one that a lot of people were espousing when interest rates were 3 to 4% a year ago. Yet we didn't see an economic slowdown, rates continued to move higher, and TLT continued to move lower since then. Still, that doesn't take away from the fact that if you believe that long-term interest rates have peaked or are close to peaking, then TLT is one of the best ways to express that view and potentially profit from it. Unlike with other types of investments, there's no credit risk when it comes to TLT because it holds treasuries issued by the US federal government. You know those bonds are going to get paid back. You don't have to worry about that. Instead, all you have to worry about is where interest rates are going to go. Now, while TLT is primarily a bet on interest rates, you do get a 5% yield when you buy the ETF, which is a nice benefit. If all you want is income, TLT isn't the right investment for you because its price is so volatile. But if you buy it with the expectation that rates will fall, it's nice to get paid that 5% yield while you wait. That 5% yield also reduces the downside you would experience if interest rates keep going up. For example, if interest rates on long-term treasury bonds decrease 100 basis points from 5% to 4% over the next year, TLT would give you a return of around 21%. But if interest rates rise 100 basis points from 5% to 6%, then TLT would only go down by around 11%. So that 5% yield on TLT is nice to have, but not everyone might want it or need it. If your goal is to profit from a potential decline in interest rates, then maybe there's no point in bothering with interest payments at all. That's the approach that investors in ZROZ are taking. This ETF holds treasury strips, which are treasury bonds that don't pay interest in the same way that normal treasuries do. They're sold at a discount to face value, and then that full face value is paid back when the bonds mature. And because they don't make periodic interest payments, strips are more interest rate sensitive than normal treasuries. That's good if all you care about is profiting from a potential interest rate decline. If rates go down, then ZROZ will rise even more than TLT. At current interest rate levels, a 1% change in interest rates will result in roughly a 26% move in ZROZ's price. Now, you can take this bet on falling interest rates even further than ZROZ does. TMF takes it to the extreme. I'm gonna say this once and I'll say it again later. Do not buy this ETF unless you have a very high tolerance for risk. TMF is what's known as a leveraged ETF. It uses derivatives, specifically futures contracts and swaps, to magnify its gains and losses. The ETF tracks those same 20 to 30-year treasury bonds that TLT holds, but with 3 times leverage. What that means is that on a day that TLT gains 1%, TMF will gain 3%. And on a day in which TLT drops by 2%, TMF will drop by 6%. If you're convinced that interest rates are going to go down from here and bond prices are going to shoot up, you might be tempted to buy TMF because it has the potential to deliver huge gains if you're right. And a lot of investors have done just that. We've seen almost $3 billion invested into this ETF since the start of the year. But I have to reiterate, this is an extremely risky fund that's not appropriate for most investors. Remember how I said that TLT lost nearly half of its value since its peak in 2020? Well, TMF has lost an eye-popping 91% of its value in that same time frame. If you do buy this ETF, be extremely careful and only invest money that you can afford to lose. By the way, if you're enjoying this video, be sure to hit that subscribe button so you don't miss future updates on investing, business, and the economy. I got a lot more videos coming soon. Okay, so I've talked about 3 investments that stand to benefit if interest rates fall from here. ETFs like TLT and ZROZ are straightforward ways to bet on declining interest rates. But there's a whole world of investments that could potentially benefit from rates going down. For example, many stocks that pay high dividends have underperformed as interest rates have risen. That's because a lot of people buy those stocks for income, and as interest rates have risen, those dividends have looked less attractive. A stock paying a 3% dividend might look really great when treasuries are yielding 1%. But when they're yielding 5%, all of a sudden that stock doesn't look as compelling and the bonds start to look a lot more attractive. So we've seen this phenomenon impact stocks in sectors that are known for paying steady dividends, like utilities and consumer staples. For instance, XLU is down 14% this year, while XLP is down 7% this year. That's much worse than the 11% gain for the S&P 500. That said, if you think that interest rates are going to fall from here, then maybe the sell-off in utilities and consumer staple stocks represents an opportunity. If rates go back down, then there's a chance that these stocks can rebound and outperform the broader stock market. Another group of stocks that could benefit from falling interest rates are those of companies with a lot of debt. That's because lower rates reduce the amount of interest that they have to pay on that debt. Small cap stocks like those held by the ETF IWM tend to hold a lot more debt relative to their income than large cap stocks. So that could be an area to look at if you think that rates are headed lower from here. Keep in mind though that there's no guarantee that any of the stocks I've mentioned, small caps, utilities, and consumer staples, will go up if interest rates go down. These aren't pure plays on interest rates in the same way that TLT is. When you buy these stocks, you have to account for company risk, sector risk, and stock market risk. Interest rates could go down, but utility stocks could go down also if the economy enters a recession and the whole stock market tanks. That's different than treasury bonds. bonds, which move mechanically with interest rates. If rates rise, they go down. If rates fall, they go up. There's no ifs, ands, or buts about it. Alright, so I've spent a lot of time talking about profiting from high interest rates using one approach, which is betting on a decline in interest rates. But what if you don't want to make a directional bet on interest rates and you just want to take advantage of high interest rates by earning income? This is the approach that's suitable for most investors. Unless you have a very strong view about interest rates, you shouldn't be speculating about whether they're going to go up or down. Instead, you should be focused on building a portfolio of investments that generates an attractive level of yield and matches your tolerance for risk. A good place to start is by investing any unused cash you have in the closest thing we have to a risk-free investment: Treasury bills. You can do this by buying money market funds like VUSXX or ultra short-term Treasury bond ETFs like SGov. Today, these investments are paying over 5% risk-free. They have no credit risk because their underlying holdings are backed by the US federal government, and they have no interest rate risk because their T-bill holdings mature so quickly. Unlike the price of TLT, which is highly sensitive to interest rates, the price of VUSXX and SGov don't move at all. So you can generate over 5% interest without worrying about the value of your principal moving around. A lot of investors have taken advantage of this. We've seen close to $1 trillion go into money market funds and ultra short-term bond ETFs this year. But as great as those investments are, they're not the solution to everything. Unfortunately, you can't just stash your cash in these funds and expect to generate 5% interest forever. Interest rates might stay high for the next few months or even the next few years. No one really knows. But one thing is for sure, they're not going to stay in one place forever. And there is the possibility that they could go down from here. So if you're invested in a money market fund, you might be making 5% today. But if interest rates go down, you'll eventually be making less than that, 4%, 3%, or whatever the prevailing rate on Treasury bills is. This is called reinvestment risk. By buying really short-term Treasury bills that get paid back quickly, you're exchanging interest rate risk, or the fluctuations in price that come with changes in interest rates, for reinvestment risk, or the risk that you'll have to reinvest your money at lower interest rates. Now, there are things you can do to mitigate reinvestment risk, such as building bond ladders where you own bonds of varying maturities. So for example, you might have some money in treasuries that mature 1 year from now, some money in treasuries that mature 2 years from now, 3 years from now, and so on. That way, even if interest rates go down, you'll continue to earn higher rates on the treasuries that have yet to mature. On the other hand, if interest rates go up, you can reinvest the proceeds from maturing bonds into new, longer-term bonds with higher interest rates. Laddering is a way to systematically invest in bonds without having to make a call on whether interest rates are going to go up or down. As you can see, investments in treasuries, whether it be money market funds, treasury bond ETFs, or individual treasuries, are a great way to profit from high interest rates. There's no credit risk, and you can pick the level of interest rate risk and reinvestment risk that's right for you. But the universe of bonds extends far beyond just treasuries. There's everything from municipal bonds to corporate bonds and more. Those bonds typically offer higher interest rates than treasuries in exchange for higher credit risk. They're not guaranteed to get paid back like treasuries are. Personally, I don't think taking credit risk in this environment makes a ton of sense, given that you can get 5% yields in treasuries and the extra yield you get by investing in riskier bonds isn't all that much. For instance, today you get about 150 basis points more yield for investing in investment-grade corporate bonds than you get in treasuries, but that's less than the average premium of 165 basis points that we've seen over the past decade. Another option for yield is to look at dividend stocks that have fallen on the back of higher interest rates, like the utilities and consumer staple stocks that I talked about earlier. Yields on those are around 2.5% to 3.5%. That's obviously lower than treasuries, but the advantage is that dividends can grow over time. Of course, dividend stocks have a completely different risk profile than bonds do, so be mindful of that, but they are a way to potentially profit from the current high interest rate environment. Now, because you've watched this video up until now, I'll give you one bonus investment idea: TLTW. This fund does two things. It holds a position in TLT, the 20+ year Treasury bond ETF I talked about earlier, and it writes call options on that position. By selling options, TLTW generates additional income for investors. This income can be substantial. The ETF has a yield of 19.5% based on its last 12 months of distributions, while it has a yield of 12.7% based on annualizing its most recent distribution. But this extra yield isn't a free free lunch. It comes at the expense of capping the price appreciation potential of the ETF. If interest rates go down and TLT goes up in price, then TLTW won't capture much of that upside because it sold options on its position. The ETF sells 1-month call options that are 2% out of the money. So any increase in TLT's price beyond 2% in a given month won't be captured by TLTW. So if you invest in TLTW, you're giving up potential price appreciation in exchange for current income. It's the type of strategy that might appeal to you if you expect that interest rates are going to stay around where they are currently or to move just a little bit in either direction. So there you have it. I hope you learned something from this video. I've talked about some specific investment ideas. Maybe they make sense for you, maybe they don't. At the very least, I hope you got a better sense of how interest rates can impact the returns of a wide range of investments. That's it for now. Be sure to subscribe if you want to see similar videos to this focused on investing, business, and the economy. Hope you have a great week and see you next time.